Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin this hour with stocks sliding after their worst quarter in nearly 3 years. Yardeni of Yardeni Research cutting its S&P 500 price target to 6K from 6,400, writing the expected fallout from Trump 2.0's reign of tariffs undercuts our former bullishness and dims the prospects of our base case roaring 2020s scenario. Ed joins us now for more. Ed, good morning. Good to see you. Second change for you in a number of weeks.
I hope you're not looking for clarity for me, because I'm struggling with all the confusing information coming out of Washington. As you said, you're getting different messages from different people in the administration, and at the end of the day, it'll all depend on what the president concludes he wants to do that day, and he could change his mind again.
How much damage do you think the accumulating uncertainty is doing already to the underlying economy?
Well, if you look at all the soft data, which is very much forward-looking, it's not looking good. The current data, the present data, looks pretty good. The labor market is doing fine. I think we had some really cold weather in January and February that depressed consumer spending. So I think we're going to have this really bizarre scenario where the first quarter we got real GDP up 1%. I know others have it even lower than that. Then it could be something like 3% in the second quarter, because you could really have a nice rebound in consumer spending, and consumers could be running to buy cars before the prices go up, which will be kind of another possibility. And then in the second half of the year, we could have stagflation, where the economy in a growth recession, maybe very little growth, if any, maybe even a shallow recession. And so that's the way I'm kind of seeing this thing playing out in terms of its impact on the economy.
And right now you and the market are focusing on the reign of tariffs. What happens when we're focusing every day on this potential extension of TCJA and other tax cuts that we may get? And they're focused on having this done before September. Yeah, well, it's going to be, if you think it's messy now, it's going to get even messier if you, on top of the whole tariff issue, which isn't going to go away just because they announce what they mean by reciprocal tariffs. I mean, the 20% number that's out there basically suggests that now the president is looking to raise revenues. Navarro's saying $6 trillion is what he claims that this could raise. And now, on top of that, we start to try to extend the tax cuts. And an extension of tax cuts, it's not stimulative. It'll be very negative if they don't get the tax cuts extended. Well, the Treasury Secretary last night is talking about that they want to get done no tax on tips, no tax on Social Security, no tax on overtime, and also purchasing an American car, making that tax deductible again. Mm-hmm. If you have even one of those sweeteners, would that be bullish for the market?
Well, I don't know that that'll make it that much easier to get it through Congress. I mean, it is a volatile situation in Congress. The margin that the Republicans have is very narrow, and the Republicans don't always stay united. So no, I don't know that those particular issues are going to be market moving at all.
At a certain point, if people are talking about the likelihood of recession, what gives you the idea that this is going to be more stagflationary than just traditionally recessionary?
Well, the thing that we all have to worry about, of course, is the consumer, and the consumer confidence numbers have all been depressed. The animal spirits that we all were kind of counting on to keep the stock market going and consumers going is kind of fizzled away here. And a lot of it has to do, obviously, with the kind of disappointment. Consumers were expecting that the administration would focus on somehow lowering prices, and instead now we will have higher auto prices if we're going to have a 20% permanent tariff on autos. And of course, if we have a 20% tariff across the board, prices are going to go up. So that's disconcerting.
I guess that the reason why I ask this is because, to Neil Dutta's point, a one-time price adjustment, but if you have less demand, you'd imagine that that would be a one-time price adjustment, and then you won't be able to have the ability to really raise that, especially at a time where potentially the labor market could come under some stress. So what is giving people the sense that this time is different, that there could be a prolonged inflationary type of bent that raises questions about U.S. Treasuries, that raises questions about what the Fed can do?
Sure. I mean, it's not likely to be a one-month event where, you raise the tariff and the CPI goes up to one level and it's a bad month for the CPI and then it comes back down. As a matter of fact, we raised our inflation outlook for the rest of the year from 2 to 3% to 3 to 4%. I think it's going to show up that quickly. And I think it's not going to be that transitory. It's not going to be 1 or 2 months. It's going to last for several months. And again, this is an ongoing dynamic process. We don't know whether more tariffs will be added or reduced. It's just kind of confusing. But I think companies have already anticipated that their costs are going to go up. Certainly, if you're in manufacturing, your costs are going to go up from all the parts. And as a result of that, we're seeing price kind of forward indicators of inflation showing that there's a problem. And so that the regional business surveys, for example, are also showing that prices paid are going up.
Begs the question, Ed, why do you think stocks are going higher by year end?
Well, I'm kind of counting on the market to look forward as it typically does. And I'm kind of hoping that all these issues get somewhat resolved by the end of the year. And I think the market starts to look ahead into 2026. I haven't given up on my roaring 2020 scenario.
Sticking with it.
I'm sticking with it. I think it's got temporarily waylaid by all those tariff issues and all these policy balls that are up in the air. But I think I guess my underlying thesis is look how well the economy has done in the past, despite Washington. And so I'm hoping that'll work again.
We've continued to underestimate the performance of this economy over the last several years. That's certainly been a feature.
Which is the reason why a lot of people are saying that actually you could see gains and you could actually see ongoing inflation. Because if you are underestimating the power of the consumer, they will be able to absorb some of this and they will keep spending. And companies know this and know that they don't have a sense of that price target as much as pre-pandemic.
Equities right now on the S&P negative by 0.4%, just a little bit softer. Ed Yardeni of Yardeni Research. Capital. Just moments ago, if you are just joining us, and welcome to the program, the Washington Post reporting the White House aides have drafted a proposal to impose tariffs of around 20% on at least most imports into the United States. This according to 3 people familiar with the matter. There's an additional dimension to this story on the tax side that I think is worth highlighting, that the president's team is exploring using trillions of dollars in new import revenue for a tax dividend, Lisa, or refund.
So this would be the sweetener on the flip side of some of these tariffs that would be, as some people are saying, the worst case scenario in terms of the most maximalist in terms of tariffs. A big question here of the timeline of how hard it would be to get those through. And I will just say, bonds are still rallying on the margin, but not nearly as much as you'd expect if you think about some of the projections from Mark Zandi, from Parthenon, talking about the likelihood of recession and unemployment rising to as much as 7% by 2027.
Tobin Marcus of Wolfe Research joins us now to extend the conversation. Tobin, good morning and welcome to the program. How about that? 20% on all imports. Now, this can change. As we always say on this program, I said just moments ago, situation's very, very fluid. But how does that stack up relative to what you're expecting for tomorrow?
Well, a happy Liberation Day Eve to you as well, Jonathan. Look, that's certainly at the high end of the range that we've been contemplating, even when you throw in gross value-added taxes into the calculations of these numbers, which are the real big thing that drives them higher. 20% as an average rate or a rate that applies to many or most of the countries that are being hit here, that's definitely at the high end of the range that we've been contemplating. I think even relative to a consensus among investors that's moved towards everyone expecting higher numbers tomorrow over the course of the past week or two, that would definitely be a surprise to the high end.
Right now, the Washington Post is saying this is just one proposal on the table. Tobin, do you get a sense that the White House has actually made up their mind yet?
By all accounts, they have not. It sure seems like deliberations are ongoing. As recently as this weekend, it seemed like there were multiple reports that the idea of a flat across-the-board universal tariff in that 20% range had resurfaced. I do think they're going to end up with more individualized country-by-country numbers in this reciprocal framework, but exactly where those numbers come down does still seem to be up in the air.
Is 20% here to stay if they go with that proposal, or is this the opening of a negotiation?
So at some level, I do think that this is the opening of a negotiation. Certainly, there will be negotiations. I fully expect that there will be talks with many of our biggest trading partners. And I think there's probably room for the numbers to come down somewhat. But I think I am more concerned than a lot of the sell side about the durability of these tariffs. And I think it's really notable that in the past week, you had both Trump and Peter Navarro talk about $600 billion a year in tariff revenue. A week before that, you had Lutnick talking about $1 trillion target for revenue from tariffs, as well as things like the new Trump gold card. Those are numbers that you can only achieve if you actually keep these tariffs in place, not briefly threaten them and then quickly negotiate them away. And I do think there's an aspiration to fundamentally redirect the global trade system. So, I think a lot of this is going to be here to stay. From a negotiation perspective, also, it's notable, if VATs are the thing driving this, value-added taxes, countries are not going to be able to negotiate those away. So let's talk about if they drop their tariff barriers, we'll drop ours. Doesn't really work that way if tariffs themselves are not the things driving these ostensibly reciprocal rates.
Tobin, how long would it take to pass some of these other sweetener proposals that could potentially offset the growth hit from these tariffs to the United States? I'm talking about certain tax rebates or tax cuts.
I think the tax bill is probably going to be enacted in a July type of time frame. Certainly, they are trying to get it done before the debt ceiling X date because the plan in Congress at the moment is to include a debt ceiling increase in reconciliation to have that be the vehicle. So that would mean they need to get it done before probably roughly mid-August. So that late summer timeline is what we've been circling sometime in Q3. It will be certainly better news for markets than the tariffs have been, but I think from a scale perspective, what's currently on the table does not look like it comes close to fully offsetting the hit from the tariffs. Like, there are good things in there, both individually and in terms of corporate tax cuts on things like bonus depreciation, but it really is at a significantly smaller scale.
Hey, Tobin, appreciate your time and reaction to the breaking news. And happy Liberation Day Eve to you as well, sir. Tobin Marcus there of Wolfe Research. Turn back to commodities. Gold continuing its record-breaking rally. Bank of America suggesting the precious metal could reach 3,500, driven by central bank buying and haven demand amid rising geopolitical and macro uncertainties. Francisco Blanch of Bank of America joins us now for more. Francisco, welcome to the show. A 19% move in the first quarter, the biggest quarterly gain going back to 1986. Francisco, let's talk about the drivers of the first 3 months of this year before we get into the next 9 months of 2025. What got us to this place?
Thank you for having me again, John. So I think gold has been really drifted up by essentially, we started out with central bank buying in the last 3 years, but I think investors have started to accumulate as well. So I think what's really changed has been more investor buying, whether it's through ETFs or other instruments, but also we are seeing asset managers and insurers starting to pile in. So that's been the change. Remember, we've seen a weakening U.S. dollar. We've also seen falling interest rates, at least on 10-year yields in the U.S. And that's kind of led to incremental demand for gold. Plus, of course, there's the issue of tariffs and the potential implications that may have in the economy. So I think all of that has come together. But gold's not alone. I mean, we've seen a big rally across the commodity complex. We've seen also coffee moving up. We've seen silver. Actually, commodities are up almost 9% in the first quarter, John. I mean, it's been a really strong run, maybe a little bit of an unexpected run. And the sector has outpaced bonds and equities across the board.
Francisco, before we dive into just generally the commodity rally, how distinct is gold given its hedge factor as well as increasing concerns, as we were speaking with George Saravelos earlier, about diversifying away from the U.S. dollar?
Well, so I think there is an element here of diversification, no doubt. I mean, central banks are now holding about 10% of their reserve assets in gold, and that number is likely to continue to increase at an annual pace of 1% to 2%. probably as far as the eye can see. Remember, one of the things that the Trump administration is trying to do is to rebalance the U.S. twin deficits. And that rebalancing of the twin deficits, by definition, implies that there is a lower desire by the Trump administration to continue to supply this reserve asset that the world has been craving for a long time, which is U.S. Treasuries, right? So if you reduce the deficit, if you reduce the budget deficit, if you reduce the current account deficit and the trade deficits, by definition, there's going to be less treasuries available for central banks around to hold. And then there's the whole sanctions and tariffs overlay here that's also driving the demand for gold.
So I guess my question for you is, have we seen the bulk of it? Why isn't your target higher? You see 3,500 as your recent target. We were just talking to Ed Yardeni, who left the office saying 4,000 by the end of this year and 5,000 by the end of this year. And it seems like people can't get enough.
Well, I mean, there's a little bit of that right now, but also remember, gold is a pretty large market already, right? It's over $10 trillion in value. So of course you can put any number there because there's no such thing as intrinsic value in something like gold. I mean, there is of course a cost of production, but as we know, mining increases the stock of gold by 1.5% a year. But the real story here is how much investment can you drive in? Of course, gold could spike a little higher, but you would need to see a much worse economic outcome than what the market is currently pricing in our view, right? So it's going to be a steady grind higher as opposed to a big jump unless something dramatic happens.
Francisco, there's a lot of research that all this has to do a lot with the uncertainty about the trade and the tariffs, the announcement we're going to get tomorrow. But how much is it just driven by the fact that it is uncertain and most people are projecting the next year to just remain uncertain? So the safest thing is to just go into gold.
Well, again, just mentioned that earlier. It's a combination of factors. When you look at gold historically, it used to be rates, it used to be FX. But now we have this uncertainty, which is, of course, triggering the purchases. But again, the uncertainty is really impacting all investors across the spectrum. As I said, we are seeing retail investors, we are seeing asset managers and insurers, pensions, we're seeing also central banks. So, and again, is it the safest bet here? I don't know, right? But are we going to continue to see interest across the board? Most likely, yes. Now, what are the downside risks? Well, downside risks is that the Trump administration is successful at rebalancing its accounts, and we end up having a very strong U.S. economy with relatively limited deficit, and therefore the U.S. becomes a very attractive place to invest again, right? I mean, a big part of the rotation to gold is also related to the drop in equity markets, the drop in the Max 7, right? So let's say that we started to see again strong growth and strong rebalancing in the U.S. as a result of all these policies. Maybe gold isn't as attractive anymore in that context, right? So I think we also have to consider the downside risks, not just the upside risks. It's never going to be a straight line for any asset.
Francisco, I just want to finish on the availability of gold and maybe lean on your conversations with clients so you can avoid offering your opinion. Unless you've got one, by all means, share it. Do you think they're losing confidence about that gold availability in places like the Bank of England? Is that behind some of the speculative drive we saw into gold over the past few months?
I don't think there's as much like a confidence in terms of the stocks of gold being there. I think it's been more about the movement of gold to Europe into the U.S. ahead of potential tariffs. Remember, there's a lot of instruments in the U.S. that are issued. There are instruments that may have a gold physical backing. And if you've promised investors on any kind of note, whether it's a structured note or an ETF or some kind of fund, that gold is going to be physically available for the investor to take hold in the U.S., you're probably shipping gold out, right? Just in case that those tariffs go up and suddenly you face a big dislocation between the product in the U.S. and the product abroad. And to some extent, we've seen that in other commodity instruments like copper, and a bit less so in the energy space because it's a little more fungible. But investors are rushing to bring stuff into the U.S. ahead of this so-called Liberation Day tomorrow in the Rose Garden. So what is the impact of those tariffs going to be? Well, again, you'd rather have your product in the US of A ahead of that potential price change because unlike currencies and unlike other instruments, commodities are going to suffer the tariffs directly, right? So it's a direct play on the tariffs, and you'd rather be in than out when those tariff walls go up.
Another record high over the past week. Francisco, appreciate your time breaking down gold. Francisco Blanch there of Bank of America. We begin this hour with stock steady as traders await President Trump's reciprocal tariffs. Emily Roland of John Hancock writing, there is still a broad-based global economic cycle that will drive earnings and valuations on stocks overall. This cycle may be borrowed time as recent economic does start to show cracks. We would consider further pruning risk in portfolios. Emily joins us now for more. Emily, welcome to the program. We've seen some major moves in this stock market through the first quarter. Do you see some big opportunities opening up now?
Yeah, John, so we are actually going to be moving to neutral on U.S. large cap equities and actually allocating those assets to credit. And really, it's not necessarily about the policy uncertainty. It's really just about the starting point. U.S. stocks have handily outperformed credit really since the stimulus boom in response to COVID. And we've seen a couple of exceptional years where earnings have been phenomenal. We've seen massive multiple expansion, back-to-back 25+% returns for the S&P 500. So we're looking to where we can prune a little bit of risk off the top there. And global equities are really what's benefiting from this rotation. It is amazing to see what the leadership has been. It's German industrial companies, it's European banks, it's Chinese technology companies. That's a really odd mix in our mind, especially as we think about the potential for tariffs to create this negative growth environment. We would actually be looking to look at income as a more important component of a portfolio than capital appreciation. So we're actually looking, again, to go neutral on credit and neutral on U.S. large caps.
You mentioned the outperformance we've seen abroad, the outperformance we've seen in places like Europe. Emily, do you think some pain might be in store for some of those European longs going into tomorrow's announcement?
I think they could be challenged just because of the velocity of the move that we've seen there. Again, if you guys remember that Sesame Street show where it was like one of these things is not like the other, that's what we keep thinking about as it relates to the cross-asset performance profile in the wake of this policy uncertainty. U.S. small cap stocks theoretically should be benefiting from the potential for these America First policies. We should see the U.S. dollar strengthening theoretically. That's not happening. Instead, we're seeing this massive sentiment-driven rotation into these cyclical areas of the globe. Typically, cyclical assets should do best coming out of a global economic downturn, and we're actually seeing them outperforming in a late cycle environment. So I think that sentiment could shift rapidly here. We have to remember that this is a global economy. If U.S. exceptionalism is at risk, if U.S. equity exceptionalism is at risk, broad equity exceptionalism here is likely at risk as well, which is another reason we think that income is going to be a more important return driver than capital appreciation.
Emily, that is the line that I want to pick up on. If U.S. equities have lost their exceptionalism, the rest of the world's equities have also lost their exceptionalism, which is a reason why you see a good place for income-producing assets. I wonder, do you see bonds as actually outperforming equities this year amid this focus on income and not necessarily equity premium?
Yeah, we do actually, Lisa. And some of the reasons that we've, made this decision is kind of just thinking about that potential. You mentioned before, U.S. high yield bonds are yielding almost 8%. Yes, there may be some spread widening. So we've come off the lows of about 250 basis points over treasuries to a little bit over 300 now. Maybe could see a bit more spread widening here, but now the income is enough in our view to overcome that. You look at standard deviation over the last 10 10 years for the S&P 500, about 18. We're looking at about 5% standard deviation on high yield bonds. And then finally, looking back over the last decade, the maximum drawdown that we've seen in stocks is about 33%, and it's 21% in high yield. So it's not that we love credit within the context of fixed income. We actually still have an overweight to higher quality bonds over credit, but within the entire portfolio, we think being able to maximize or to minimize drawdown, to be able to lower standard deviation, and to be able to get nearly an 8% income on high yield is a decision that makes a lot of sense.
Emily, when we started the hour, John talked about how sentiment's never been lower, at least not in the recent past, even though we haven't seen an even bigger bear market in broader stocks. And then I started to list off this recession call, this person is downgraded 5 times. And I was thinking to myself, I sound really bearish and I sound as though we're heading into Armageddon. And is that a contrarian indicator? You know, the idea that we have discussed all of these worst case scenarios at a time where the consumer's balance sheet is still pretty good. You do have companies that are still performing okay. Is there a sense that maybe we've gone too far and equities can reverberate back, especially led by big tech?
There is. I mean, at the end of the day, it's not that bad as it relates to the hard data. We watch things like initial claims really closely on Thursday mornings. We've been in the low 200,000s. There are some cracks forming there. Continuing claims are elevated. We've seen job openings slowing. We'll get another read on that this week. But the hard data are holding in really well, especially as it relates to the labor market. The challenge is the soft data is horrible. Consumer expectations hitting a 12-month low. University of Michigan Sentiment Index declining. You all have talked a lot about that on the show. We've got to be mindful of that. First of all, that soft data just soared after the election. We saw just massive optimism, things like home builder sentiment, NAHB. Again, some of the sentiment surveys around expectations soaring, especially on the Republican side. But we've seen a little bit of a give back there. And then we also have to remember that businesses and consumers sometimes say one thing and do another. I think durable goods coming in solid last week was another example of that. So we've got to be mindful. I'm not saying completely ignore the soft data, but we're watching the hard data for signs that a contraction is happening or something more nefarious is going on, and we're just not seeing it.
Emily, appreciate the update as always. It's good to see you. Emily Roland of John Hancock. This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.